Welcome to the Influential Personal Brand Podcast. This is the place where we help mission-driven messengers just like you learn how to build and monetize your personal brand. My name is Rory Vaden, and I'm the co-founder of Brand Builders Group, a Hall of Fame speaker, and New York Times bestselling author. And this show is to help experts learn how to become more wealthy and well-known. I know you're going to love it. Thanks for being here. Let's get started.
Hey, everybody. Welcome back to the Influential Personal Brand Podcast. I get the privilege of getting to interview someone today that I have been learning from behind the scenes for actually a few years, and actually hired the company that he works with, Simple Numbers, to actually come in and work with Brand Builders Group about 7 months ago. And Greg Crabtree has been notoriously renowned in the entrepreneurs organization community for pretty much like the 10 years I've been a part of EO. And I read Simple Numbers. I'm currently reading his second book, Simple Numbers 2.0. And it's here's what I would say, and this is a great testament to you, Greg. The title is exactly what's in the book. It's how do you make very challenging, difficult numbers simple so that as a business owner, I can apply those to my financial life. So to get to have you on our podcast today is a privilege, because selfishly, I'm going to get to ask you all these questions that I want to know. But also, I know that if I want to know the answers to these questions, so does everyone who's listening. So I know this is going to be applicable and universally sound for everyone who's listening. So without further ado, everyone, let me give you a formal introduction to Greg Crabtree. He is a CPA, a speaker, an author, an entrepreneur himself who has dedicated his career to helping entrepreneurs build the economic engines for their business. As the founder of Crabtree, Rowe, and Berger, Greg has pioneered revolutionary metrics for measuring two very important things we're going to talk about today: labor efficiency, and then also something that we've really adapted in our company culture, which is contribution margin, to help financial reporting for business owners. So, Greg, welcome to the show. I'm so excited to have you.
Yeah, I appreciate it. Thanks for having me. That's a very, very nice introduction. I appreciate it.
Well, and here's why I asked for you to be a guest on the show today is I think it's very challenging in a world where there's 1,000 different things that we could be looking at, and financial dashboards and metrics. And you have so many terms and terminology that just don't necessarily make sense in real world application. It's like, yes, okay, I know what my profitability is and I know what gross margin is, but how do you actually use those numbers to make decisions in your business is something that I think you just do so extraordinarily well. And it's something I'm really excited to talk about today. But before we do that,
Yeah.
I mentioned to this before I hit record, I was going to ask you this question because you could have done 1,000 different things and you chose to be in the world of finance, and not just in finance, but in the world of finance for small business owners, for entrepreneurs. And we can be a seemingly difficult audience to appeal to. So
Just
how'd
a
you
little
get into this, and why have you stayed in this?
bit. Well, I mean, first and foremost, I chose accounting because they worked in an air conditioned office. I mean, so when you go up on a chicken farm and hoe cotton in the afternoons when you're not gathering eggs, you just want to, work in some place that isn't, hot, smelly, unpleasant. Once I started in the profession and got out of school, you realize what they taught you in school is not what you do every day. And after the shock of that wore off and I had to make a living, like many of us, we gravitate to the thing that fits our passion. And so I through a series of changes, the firm I worked for originally, I got hired by a bank client of theirs to be their controller. That was where I kind of developed my technology skills and love of kind of modeling and forecasting, with spreadsheets. And this is like first generation PC. I mean, I was running out of disk space every time I turned around because I just kept pushing the limits of what it would do. And then left there and went back into practice because I really had a passion for more, working directly, with multiple clients rather than just working for the bank. But even that had its moments of you kind of get drug into, the stuff that, you tell somebody you're a CPA, the first thing you get is a tax question, and And it's like, yeah, I mean, it's necessary, but it's not the prime thing. And really for me, I mean, and I wish this had come along sooner in my career, but in 2001, I got introduced to the Entrepreneurs Organization. And that was just a transformative moment, because at that moment, I had a couple partners. We had a barely qualifying $1 million CPA firm in Huntsville, Alabama. All of our clients were local. And since then, we became entrepreneur focused and really more consulting first focused. And that, we've now grown that practice to about 7 million of revenue, and our clients are all over the world. And 98% of what we do is not in Huntsville, Alabama. And, but it all came because of that focus of really asking the question that I really attribute to my first EO forum of what is our, when I asked them how many would recommend their current accountant, the answer was none. So that from a net promoter score basis, that's a pretty sad statement of a profession. And as a profession, we sell people what we do. We don't do what they need. And there's a truth to that in just about anything in the world. And so the idea is, figure out what the market needs, and that takes some time and takes some effort. And then once you find that need, you got to find a way to solve that need profitably. And then you start building the marketing engine to say, let people know that you exist. And even to this day, I mean, we still, people try to put us in a box. Oh, you offer fractional CFO services. No, not really. We may eliminate the need for fractional CFO services, for what we do, but no, that's not the box we fit in, and so it really comes down to, we really want to help people optimize profitability, optimize return on invested capital, which is a very poorly understood, topic of the capital you invest in the business. What is the return that you should get out of it? And you make that business as profitable and capital efficient as possible. And then you've got the best of both worlds. It's a very valuable business should you ever decide to sell it. And it's a very valuable business should you decide to keep it. And, and fortunately for me, the study of the data is never ending, because it's like, and I don't go to the data to with a proof text I'm trying to prove. I go to the data to say, what are you saying? What talk to me. And so really it was more so an approach that I had to do something that accountants loathe to do, is I had to go study data without somebody paying me to do it. to develop, I mean, and you've worked with us a while now and you understand, we have deeply held beliefs of how things work, not rules. No, these are beliefs. And for the most part, there is only a handful of numbers that truly matter. And it's easy to, get worried about some other numbers in your data and says, well, I get that, don't waste money. I had a call this morning before this call that, a client that's in a rapidly growing mode, and they were worried about, hitting their labor efficiency targets and their operating expenses that increased. I said, don't worry about it. It'll be fine. I said, you're not spending money. That's not crazy. You hit that LER number, you will have that level of profitability. Well, you got to go crazy with the OpEx number, for that not to happen. And once you understand the power of leveraging labor and efficiently deploying capital, you got something that puts you miles ahead of every other business out there, in that process. But they don't teach us that in school. They don't even teach you that, in the world of business, because there's all of these, rules of, business is valued at 10 times EBITDA or 5 times EBITDA. It's like, yeah, maybe not really. Those are benchmarks, when people are talking about values. But if you have, I can get 10 times EBITDA selling a business that has a really bad EBITDA number. It didn't mean I got my value for it. And I can get 5 times EBITDA for a number that I've got a very strongly adjusted EBITDA number that I win the argument for, and I get the right number. So a lot of those things, there's a lot of lore that goes around in business. And I just try to stick to finding what's truth, what is really truthful. And trust me, in the world of accounting, audits aren't truth. audits are, are things that, it's just generally accepted accounting principles that have a tendency to just confuse things more than they help, and put a lot of weight on the data. And, oh, by the way, anybody listening to this, that if you've ever had accountant prepared financials that got sent to the bank, why is it that the bank calls you back and asks for more information? If it was actually a sufficiently prepared document, the bank wouldn't have any more questions. And so once again, it identifies the deficiencies of what existed in the marketplace, but it can't be so deep into the weeds that, you're picking lint out of your navel to kind of figure out what's wrong. Yeah. I mean, it's like, come on, people. I mean, there are some long held principles. And to be quite honest, everyone that I talk about, I learned from a client. I didn't learn from school. The only thing I learned from school was I'm fortunate that we've done about 10 years of the program now. I get to host the EO at Horton Executive Ed program. And I've been the host since the beginning. And one of the early years of that program, actually the first year of the program, our lead professor, David Wessels, was talking about return on invested capital. And I'm sitting in the back of the ring going, I knew about that in school, but we never used it. We never did the calculation, and they got enamored with the idea of it. But come to find out, there's really no private company data around that topic. And so I just started studying it because we have access to data. And so we have hundreds of businesses we can look at, and we started to find this very identifiable correlation of a capital efficient business that's producing the right amount of profitability relative to the capital invested. Because in the world of business, there's really, you can identify businesses of, do you have accounts receivable and inventory? Those are tough businesses to get a good return on, because I'm carrying two things that turn over on a frequent basis. Do I carry one of the two, but not both? Okay. That gives me a little higher return potential. I'm a business that I don't have AR or inventory. I get to bill either up front or as I perform the service or sell the product. So that's even better, and do you have a big capital component of equipment? Well, we're a very heavily dominant service-based economy in the US, although we do have some capital intensive businesses. But there's a way to look at all of those things and equate it back to setting your profit target and then giving somebody something definitive to aim at. And I would say probably my greatest amount of pride in the work that we've done is giving people a very specific, definitive target that is unique to their business. That, and as I always say, a man who aims at nothing hits it with amazing accuracy. Well, and when somebody just gives you an opinion about something, you're not committed to that thing. It's like, sounds nice, maybe we'll hit it, maybe not. But when you give people definitive things of, hey, I need to be a 2 total LER. I need to have 2 months of operating expenses in cash with 0 drawn on a line of credit. I need to be a 75% return on invested capital. Those are definitive things.
Yeah. That
gives you trade-off decisions of, well, I can grow. Well, but is growth good? Not all growth's good. I'm here to tell you, we have seen many times people have grown and made less money.
Yeah, I think that happens, I think, a lot. And you've mentioned this term a couple of times. It's one of my hot topics for today because, and I love what you said, there's lots of numbers you can look at, but there's only a few that are like really instrumental to really understand. And up until the last year, I had never even heard the term of LER, labor efficiency ratio. And I consider myself fairly savvy in the financial business world and never had come up, not in school, not in all the courses and all of the, I've done like anything from, like my financial like MBA course to like none of that had really like come up to how do you use that in business? And so I'd love for you to first of all explain, because I think even definition wise, if you were just to go Google it, it's going to be slightly different than how I believe you guys use it and practice it.
Well, actually, we've become known enough. ChatGPT has read both of my books, and so it actually will give you an accurate, answer.
What it is and like value and importance.
So it really requires a couple of things to think of. Number one is revenue is the slipperiest number on the P&L. And, probably to go back and thought of why I started looking into this is I was frustrated with the annual requests that I get from clients who want to be included in the Inc. 500, Inc. 5000 list.
Ah,
And I've long since granted, great for Inc. magazine to generate awareness. And yes, it's a great marketing tool. And I get all that piece. But from a metric standpoint of growth of revenue, is you're not rewarding the most deserving companies,
mhm,
because there's a lot of companies on that list that unfortunately I do know the background of, that revenue is about as worthless, as it gets. And so, as they say in Texas, all hat and no cattle. I got revenue, but I ain't got profit and I ain't got margin.
yeah.
And so it really kind of led me down this path. When I was on the EO Global board, I started working with this thing that I kind of keep in my hip pocket, and we'll probably use it here soon. But I came up with basically a business health scoring metric that looked at not revenue growth, but gross margin growth. And the way we define gross margin is revenue minus materials or subcontracts, not labor. So I want to get to a gross margin number that is the pure value of what's left over for your labor and your overhead to do in the business. And because everything else is really a pass through, at that point of materials or COGS. And so that gross margin is the true economic top line of the business. And if you measure things off of it, well, then we started looking at, let's measure things off of it. Well, come to find out, the more you study the data, there is a very, very tight correlation of all labor, doesn't matter if it's direct or management, all gross wages, not loaded for payroll taxes either, keep it simple, just wages to gross margin. There's probably 80 to 90% of the businesses operate off of one simple metric. I need $2 of gross margin for every dollar of labor to hit my profit target. And you couldn't get more simpler than that. And then we can take it and split it between direct and management for a next level view. Now those that, we look at total LER as a health diagnostic. I mean, literally in 5 minutes, I can look at a business and tell you where its problem is.
Mm.
That's how simple the analysis is. And once you look at it, you go, okay, well, what can you do it? Well, let's split it between direct and management, and then let's watch it move across time if we've got some historical data compared to now. And those individual measurements of direct and management is more about your labor strategy of how you go to market. I can win the game a lot of different ways, but direct and management play off of each other. If I go expensive direct labor, I'm going to have less expensive management labor. I can go balanced between the two, or I can go inexpensive direct labor. Then I got to have a lot more expensive management labor to cover the deficiencies of the direct labor that get you in trouble.
Now, the direct labor, revenue producing labor, right?
Revenue, really, essentially, think of it like this, and we don't get too wrapped around the axle about it, so don't overthink it. Somebody that spends 30% or more of their time facing the customer or making the thing that you do happen, if you're a product or service business. So really, I don't care what their title says. We have plenty of people that have the manager title that we put into direct labor.
Mm-hmm.
Matter of fact, in our office, I'm direct labor. I still face clients more than 30% of the time, in billable work. So, hey, let's face it, I don't want to do management labor. I like doing this.
Mm-hmm.
Right. And so from that standpoint, but that's really just more, we call it a butt in a bucket. Don't split people, don't allocate. I'm an avid anti-allocator. I mean, in the world of accounting, accountants love to allocate things. Allocations are just jobs programs for accountants. It just takes up time and just pollutes the quality of the data, at the end of the day. And I'm not going to say that there's no cases where you allocate, but you want to allocate as the last possible choice to get clarity of the information.
Hmm.
So at the end of the day, we call it a butt in the bucket, put the whole person into direct labor or the whole person into management labor, and then watch it move across time. Is it getting better? Is it getting worse? And typically we don't like months are a highly inaccurate period of time. So we're looking at rolling 3 is the shortest period we look at. And rolling 12 is your most authoritative period to look at. And then you can look and see at this mix. And for the most part, I mean, client I was talking to earlier this morning, I mean, they've gone through this transition and they've been growing, but their total labor efficiency ratio had fallen to below their minimum acceptable target. And it was all in one place. It was in management labor. They had, their direct labor efficiency actually had gone up, but their management, they'd gotten really heavy and lethargic. And this is growing companies fall into this trap all the time. Oh, we need to add people to this. And you might, but for every dollar of management labor you add, you have an output component. And this is really why I think management LER was even a more revolutionary component than even total LER. Because once you have something that your management labor has to attain to, it has a definitive measurement that, because if I add management labor, okay, now I've reset the target of contribution margin you're going to get. And then that works its way up to then, an estimate of revenue that we've got to go get. And if anything below that number is unacceptable, that's just a definitive measure of successful performance. And
What
so,
would that be? Like, would you say there's like a baseline of like what you would say anything below this is like,
no, management labor, I mean, the individual metrics, there are some guidelines within certain industries. I mean, we have, the one we have a lot of mastermind participants in is IT MSPs. And we kind of identified the neutral success for MSP is a 2 total LER, like I said, and you want a 3.5 direct labor and a 3.5 management labor. Now, those two are those two individual components have a different numerator, so that's the reason why they're the same number. But we've got people that are above one and below the other. Okay, but the two balance out to get you to the 2 total. The key is you got to get to the 2 total.
yeah,
And then once you set them side by side, you start to realize, oh, you're pushing inexpensive labor, but you had to compensate with more management. Oh, you're pushing expensive labor and you got a really skinny management. All of those so think of it like this. If I have really expensive direct labor and I really inexpensive management, problem is I have nowhere to go. They say my expensive labor, last time I checked, still likes to get raises. Well, they're already expensive. Will the market let me continue to charge more? Now, when I go to the other end and I got inexpensive labor and I got the management, that's more of what I would call a team development model of where, okay, I'm going to grow these people and, we're going to go from inexpensive direct, expensive management to balanced. We're actually moving from that strategy to the balance mode. Once we get the balance, we have to decide, are we going to go all the way to expensive direct labor eventually? Maybe not. That's the one where I typically find a lot of people are stuck and they get some terrorist on their, a terrorist in labor is a person who doesn't fit your culture, but they're a high producer. Those are people that, when we look at it and, you kind of get stuck with those.
It's interesting because I think one of the reasons that I was so drawn to this concept of LER, labor efficiency ratio, is because me, like so many other people, doesn't matter how big your team is. You could have a team of 1 or a team of 1,000. There's always this never ending commentary in business of there's more work to be done than we have the team to do the work. Right. And there was a lot of conversation.
And I'll give you a good data point for that. So in our most recent Horton class, and I did the same question the year before as well. We get 60 entrepreneurs from around the world, all different kinds of businesses. Half of the room, I ask a question, what is your biggest constraint? Getting revenue or getting access to labor? Half of the room is revenue, half of the room is labor. And what you typically find is the necessary businesses of the marketplace are labor constrained, and the discretionary businesses in the marketplace are revenue constrained. And that's become a very interesting learning over the last couple of years as we keep what we call the simple numbers 100 company model. So we have 100 of our clients that we put in a model, treat it as one big conglomerate because businesses from all over the U.S., all different industries, all different geographies, since we're not geographically centric. And it's our read of the economy.
Mm.
And one of the things that has really emerged in the last 5 years going through COVID is the separation of the necessaries and the discretionaries.
Hmm.
And the discretionary businesses are getting their head handed to them right now. And so when people, write articles or go on the news and start talking about the economy, I mean, they're painting with a pretty big brush, because I got news for you. We got people that are crushing it, and we got people that are hanging on for dear life,
Mm.
and everybody in between. Now, we tend to like to think that we can move the needle a little bit, to the better, and we do, but still, I mean, there's only so many things we can do when somebody's facing a market, selling a product or service that there's just not sufficient demand for, because the people buying it are the bottom 60% of the wage force that has no extra money at the end of the month. They have to make hard decisions.
Mm-hmm.
And we've been in that mode for about 24 months now, that those discretionary businesses they're hanging on like this, that they'll have a good month, they'll have a bad month. They'll have a good month and a bad 2 months and a good half a month. And it's really schizo. And that consumer base that they're relying on is really struggling.
Mm.
Whereas, the other part of the discretionary market is what we call the highly desired discretionaries. So those are the people selling to the top 30, 40% of the wage earners, but still you got to fight for their wallet.
Mm.
I mean, even those people make discerning decisions about what they spend money on, and they don't spend consistently, that things will get hot and things will get cold. So a good place that you can kind of see it right now is like in the restaurant industry. The bottom end is hanging on okay, but their labor costs are high, but you've seen them do everything possible to take labor out of the component, closing dining rooms, doing online ordering a kiosk, and all of those things. The upper end, they're fine. If you're good, and you do good food and deliver good service, your parking lot's always going to be full, because there's enough people that have the money, to deal with you. It's that middle tier that's getting crushed.
Mm.
TGI Fridays went bankrupt. There's a couple of other, mid tiers that are teetering on bankruptcy, because their costs have elevated to the point that they just can't charge enough to cover those costs, because it pushes them into that upper tier pricing, where somebody will come in and go, well, that was good. It wasn't that good.
Yeah.
And there's a lot of that. So there's a lot of, and every industry kind of has, some of those same components. But if you're in one of the necessaries, guess what? You can raise your prices to whatever your cost input is. Because if you're, we'd have a mastermind group I'm about to go visit in the HVAC space. They're doing really good. Now they're labor constrained, because there's not people that are HVAC techs walking around looking for jobs.
Sure.
But as those people as you keep having to pay those people more, you just charge more, because when you're cold, you need them. When you're hot, you need them.
Yeah, I think that's a good. I think that's a good point of distinction between what's necessary and essential versus discretionary. And I think one of the things I'd love for you to talk about too is like, because I hear this even in our own company. It's like, hey, I feel like it's time to hire someone.
Mhm.
And what I love about LER is it tells you
Exactly.
more data driven of, are you in need of more staff, or is that just a feeling that's a
Well,
team? Can you talk about that a little bit?
so once you set the parameters, so like I said, most people listening to this they're going to fit that 2 profile. If you're a restaurant, you need to be a 2.5. If you're a distributor, you generally need to be a 2.5. If you're a union shop, you need to be a 2.5. But most everybody else is a 2. If you're a staffing business, you're kind of off the grid in a totally different mindset. You may be below a 2. So I'll keep staffing businesses to the side. But almost everybody else kind of fits within those categories.
Hmm.
If we establish, say, listen, if you're at a 1.8, you're going to be at 15% profit to gross margin, which is good. But we want you to be at 20. And it's not profit to revenue, which would be profit to gross margin. You get to 20, you got to be a 2. So there we've set your parameters as don't go below 1.8. That's your no-fly zone. And when you get to a 2, I want you to look around and see, is anybody stressed? Are we running hot? But if we're not, let's see if we can get to 205, maybe 210. Find if you have found a way to be marginally better than your competition. And there's a few times that you will have windows of time. This won't last forever. You've got the click of a team that really gels. Your operating costs are optimized for the range of revenues that you're doing. And so you've got this window of incremental value that just drops to the bottom line that gives you that extra little juice. But trust me, if you grow, you'll kind of lose it, and it'll still be okay. And if you kind of hit that rough patch of the economy and the economy goes soft, it'll drop down as well. But you're trying to live between that 1.8 and the 2. And, and when and if you're not there, let's say you're operating consistently at $1.75. All right. So we go into the 3 P's. 3 P's. First, have I priced effectively? That's my first place I always go. Have you defended the value of your team? And that is on management shoulders. Don't be a wimp. Got to go defend for that value. And there's a lot more room for pricing than most people believe. Has been our experience over we've seen more price changes in the last 5 years than we've seen in a lifetime. And so I'm telling you, most people have not pressed the edge. Once I get to the right price though, and I can defend it, and I'm getting the right value, and I'm letting the bad customers go to my competitors, and I'm keeping the good ones and serving them. The next thing is process. Have I given my team the right tools, procedures, training? Are we getting things, David Wessel's one of our lead professors at Wharton, talks about speed and power equation. And I love that. Power is margin, pricing power. Speed is clock time from beginning to end.
Yeah.
There's undoubtedly any project that expands in length of time becomes less profitable. And so, there's a significant lack of a sense of urgency in the productive environment of most businesses.
I agree.
So I've got to create a culture of everybody's on target. Once I get through those 2 P's, there's only 1 P left. People. Do I have the right people? And to take a college football and basketball term, the transfer portal of business has some talent in it at the moment. I don't think it's going to be there long, but there is some available talent that I would kind of be paying attention to, and you might be able to upgrade your team. There's perfectly good players on your existing team that end up going elsewhere because you had to sit down and have an honest conversation with them and going, I like you as a person. You're a great person, but I don't think this is the best place for you in the world. And you got to have those honest conversations with people. And, how many of us have had in our working career before we became business owners, somebody sit down and do that with us? Probably not very many. We had to kind of find it out on our own, but Robert Glazer is a longtime EO member out of Boston. Robert came up with this concept that we've used quite successfully of what I call the mindful transition, where I got a good person, but they're not going to get to their personal LER. We can actually measure LER by person, so not everybody can, but with our metric approach to things, we can, so I can look at somebody and go, love you as a person, you're just not going to produce that. I can't, you're using up a productive slot of the business that is under optimized. That means there's a better place in the world for you, which means, hey, if you're not disruptive, you need to be looking. And there's a good job market. There's plenty of jobs available. That's the nice thing about this time of life that's not existed before is the economy might be kind of sluggish, but everybody's got a job that wants a job. That may not be the job you want, but sometimes you got to work at it a little bit. But, we can give those people extended, 60, 90 days to go find another job. As long as you're not disruptive, you don't make a scene about anything, we're fine. We're not grossly losing money, but we're not optimized, within. And I'll give you a great example of that to put in everybody's head.
Yeah.
So in the world of car service, auto service businesses, they actually pay mechanics on a book rate. So if you're going to go replace a carburetor in a car, book says takes 7 hours. So you're going to pay the service technician 7 hours, whether it takes them 3 hours or 15 hours to replace that carburetor. It's one of the most unique industries that exist of paying people for the value of what was done, not the hours that was done.
Mm.
Now, labor requirements, you can't pay them less than minimum wage, but that's a pretty good indicator you got the wrong guy. Now, unsuccessful people in the car service industry think that, oh, I don't have to worry about underperformers because I'm only paying them for what they produce. No, 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 no. In the car service business, it is the margin that goes through the bay in a day, not what you paid the person. So if I have an underperforming service tech that's taking twice as long, yeah, I'm not having to pay him, but I'm missing the opportunity cost of that bay turning over more activity. And I think we've got to look at our productive team and say, just because you're not costing me money doesn't mean you're optimized, and you're not in a good place and we're not in a good place because of that. And so if I can't get you up to speed, we got to make a change. And I know that sounds heartless and cruel, but there's a, like I said, Robert's demonstrated, and we've been successful with that approach of going, listen, let's just be honest with each other. We'll help you. And, you don't have to do the Friday afternoon walk of shame with a banker's box, leaving under the cover of darkness, and have people with some dignity. But everybody, my energy level, because I get to do what I really like to do every day at my age. Oh man, I don't think about retirement. This is fun. Why would I quit?
And I think that's kind of to the point of what you were just saying too. It's like if there is a, unproductive slot on the team, the likelihood they could be productive elsewhere is a high potential. They're just not being productive here. So it's beneficial to both parties. And that's what I love about this financial. And it's interesting because this is a very HR written kind of talk around people, but it shows up in the financial statements.
Right.
And I think it's a really important.
It's the most important thing in the financial.
Right. And it's like, but I think a lot of people silos those two things and don't look at financial statements to make HR related decisions. And this is combining those things for the entrepreneurial company.
Well, really, and I think
name.
Well, I think you would agree with this. The thing is, financially minded people look at labor costs no differently than rent.
Mm-hmm.
And it's like, are you kidding me? Labor is the special cost that produces. Rent's there for a reason, but when you dehumanize people and think of, this is a cost that just has magical properties when it works. Now, one of the things I will say that we're noticing, so we're in a period of the economy that, like I said, if I look at my model and you tell me, what do I think GDP really has been? I think we've been somewhere between 0 and negative 2% GDP for about 18 months, based on the data I'm looking at. And now it's a really hard number to measure, especially in a service-based economy, but that's where my feeling is. For every company that's up, there's a company that's down.
Mm-hmm.
And so in that, kind of an environment, of this flat economy, what we're seeing is companies with good cultures are starting to separate for the first time economically. Now, they were a better place to work, but rarely did they actually have better economic performance, which is sad to say, but people never talked about that. I take away the Googles and the Facebooks of the world and make insane money, and they can throw, they can buy you food every day and all that. I'm talking about ordinary everyday businesses that we can't afford that kind of stuff, but we got to have a good culture. We got to have each other's back. But there's those ordinary businesses that are the dirty job businesses that have great cultures.
Mm-hmm.
And those are separating, which I love it. This is, matter of fact, I love this market more than any market I've ever worked in, because it's going to show success for those who are best. Because the last 25 years has been the participation trophy economy. The economy was growing so fast that you could roll out the ball and pick up a game and you didn't have to be good. And those people sucked up a lot of the activity of the market that should have gone to the better businesses.
Mm.
Now this is a good competitive market. And if you want to grow in this market, you got to go take your fist and punch your competitor in the mouth and take their business away from them, because the market isn't growing.
Yeah.
So we're in a market share growth economy, not a growth economy. And I just hope to get my share of the new growth that comes along and be better than the others for the new stuff that comes along and be better positioned for that.
But that's
No,
a huge
no,
opportunity for people who are the better business
no.
to take market share.
Yes, absolutely. But
So,
see, we haven't had to think about market share acquisition for 30 years.
mm,
Probably since the 90s. When the 90s was probably the last time, that the economy probably had some vestige of a market share. The GE days of Jack Welch. I mean, he talked about being number one or number two in every market that they had a subsidiary in. So he thought about that way. We're getting back to that kind of a marketplace,
mm,
but even on a much broader scale.
yeah, that's even like for the micro businesses and local
Yeah.
market. I think, and I love this concept of LER for those reasons. There's another concept that you talk a lot though that I had also never heard about, which I'd love to talk about before we run out of time, is contribution margin.
Right. Mhm. Yeah. So
So similar to LER, labor efficiency ratio for everyone. I'm going to
yeah,
keep repeating that.
yeah,
This was another term that was fairly new to me in this, kind of
yeah,
business owner world that has now become like the leading indicator of
yeah.
our company health and had never
Yes.
heard about it a year ago.
It's a closer derivation from what we call contribution margin. Most people would refer to as gross profit. Now, I'll give Vern Harnish credit for this, because when I was writing the chapter for Scaling Up back in 2014, Vern and I was having a discussion after I'd written the chapter, and I'd used the term, instead of contribution margin, I'd used the term I used the term gross profit instead of gross margin. And he recommended eliminating the use of the word profit unless you're talking about bottom line. And I thought that was a very brilliant insight, because he's exactly right. But what already existed, which helped in terminology there, if you look at QuickBooks, traditional P&L, you're going to see a gross profit number, a term, which is after cost of goods sold, which includes your direct labor. And we were very adamant. We said direct labor should never be mixed with something that's not labor. Labor is the only cost that comes to work every day with an attitude. It has a variable output component to it. And so once you separate the non-labor cost of goods and then your direct labor, we wanted a clean term to call that. We didn't want to use gross profit because that would confuse people with gross margin. And so we said, well, it's a subset. So use the word margin and attach a modifier word to it. So we came up with contribution margin was what we named it. And essentially, you're exactly right. I contend that contribution margin is the most important number in the business because it's the output of your business engine. It's the horsepower measurement. And so when you're talking about buying a car and you want to know what's the horsepower of that's what contribution margin is. And so, but it's a clean number with only three inputs. How much your revenue, what's your cost of goods of materials and subcontractors, and then what's your direct labor. And that's direct labor with no add-ons or any of the other loads that are unnecessary. It's a clean number. And what we found is one of the some of our clients who use bonus programs, we believe that contribution margin is actually the best critical number to base performance measurement programs for bonuses and those things off of, because it's the number that everybody in the business can do something about. Everybody can do something about contribution margin. The costs that come below contribution margin largely rest in the hands of the owners or a handful of people in corporate.
And what would you
And
say, like, for everyone who's listening, because I want to make sure this is in the show notes. What is the calculation for contribution margin?
revenue minus cost of goods minus direct labor. So it's
Right.
those three numbers. Now we draw a subtotal. So revenue minus cost of goods is gross margin. So gross margin minus direct labor is contribution margin. Now, contribution margin becomes the numerator that we hold management labor to. So this was a huge thing. So when we identified that started striking fear in the hearts of management teams that we'd work with, because we actually had a way to hold their wages accountable to output. So they want to go on the top number. Well, that's the slippery snake. Not every dollar revenue is the same value. That contribution margin is you had to sell it, you had to manage the direct costs, and you had to manage direct labor. Those are the three primary functions of management. I got to be good at all three. I can't just focus on one to the detriment of the other two.
That's good.
Yeah. And that's why it is the supreme number that really tells you the directional health of the business.
Yeah, and ever since we started working with your team, it's like we reevaluated our entire bonus structure, the financial dashboards that we look at it every single week to make sure that contribution margin was the leading indicator of what our management team is looking at to go, are we doing the thing that we're supposed to be doing?
Yeah. Yeah, because and think of it from the businesses that have a choice of either doing something internally or contracting it out. Well, the net benefit of both of those activities fall into contribution margin. So I can subcontract it, all of it, subcontract a piece of it. I can self-perform all of it. But the same net number has to come out to justify the existence of management that is down below that number.
Mm-hmm.
And that ratio of output of contribution margin to a management labor dollar is really your North Star of management labor effectiveness. And we see this all the time as businesses go through growth phases. I look at that management LER number and you're growing, but your management LER number is going down or even staying flat, which is telling me that you continue to give away your gain to the management team in labor costs and you're getting no leverage.
Mm-hmm.
That number should get better as I get bigger, not flat to declining. And same thing. Now we can take management labor, which generally also includes your sales labor. Bigger companies, when we'll take that number and separate it into two pieces of looking at sales labor separately from management labor. We've identified many of flawed sales compensation plans because sales LER, which is based on its numerator is contribution margin as well. That sales LER is flat to declining, which tells you I get no leverage from somebody selling more.
Mm-hmm.
Well, the company has got to get a better end of that deal.
Yeah.
Or else you're just running that wheel faster and faster and getting less and less out of it.
Yeah, it's one of the biggest lessons that I learned as a young entrepreneur is like the number one reason most companies don't last is they simply run out of money. And that's not revenue, it's that there's no money left over, right? And at some point, that's, it's mismanaged financials is the right word, but it's a true lack of awareness of the different levers that run a business. And that's why for everyone who's listening, I know that we're talking about seemingly complex concepts, but y'all, the book Simple Numbers and Simple Numbers 2.0, highly recommend the simplicity of taking these seemingly complex terms and making them exactly what we just said. They're simple numbers that will help you guide your business. And if you want to learn more about what they do on a consulting and a business aspect, just go to simplenumberscri.com and you can learn about all the thing that they do for companies like they do for ours at Brain Builders Group. And if you want to learn just more about Greg, you can go to gregcrabtree.net. He does speaking engagements. You can learn more about his books there. But these are financial terms that help businesses and help personal brands ensure that you have the runway to do the thing that you started out to do, which I think is.
Well, I think much in the way that, you tell a story with somebody's brand. We essentially are storytellers with data because like when we did our planning session with you, we didn't just look at the current snapshot of your financials. We didn't just look at it compared to a single point in time in the past. We looked at it across time in a flow state. And what we found is when I can tell you a story about this is what the data is telling you here, and you think back to what was happening then, here's what the data is telling you here and how that's reacting. Y- You're exactly right. I mean, the entrepreneurs struggle with time context of what they feel about what's happening versus what the data is telling them. And what our goal is to get those from out of time sync into time sync. So I want your feelings and the data to be aligned, at the time. And I think it is just a handful of numbers that help you do that.
Yeah, and I would tell you every single time that I get on a call with our Simple Numbers representative, my feelings of, "We're not hitting our numbers, we're not doing well," he very quickly is like, "What numbers are you looking at? When we look at the historical trailing 12 months, you're doing great." And I'm like, "We are? We are?" And
Mhm.
it's again back to it's the feelings don't often match the facts, but you
Right.
gotta have the data in front of you to
Right.
line those up at the same time. Okay, Greg. So I know we have just 2 minutes left, and I have 2 very quick questions for you.
Okay.
This is for the early on entrepreneur and then
Yeah.
also for the more advanced established entrepreneur. If they
Yes.
were listening to this episode, what would you say is the number one action item that each one of those categories, the early on, just getting started, and the advanced person should do leaving hearing this conversation?
Well, in essence, a little bit of both, but especially the early on entrepreneur, you're trying to get to financial truth. And so we talk about this in the first book. Really, the first 4 chapters of the first book is just primary reading material for that that $1 million or below entrepreneur, because you got to get your salary set to a market wage. You got to eliminate distortions in your data so that you're being honest with yourself about the economic truth so that you can set pricing, process, people, to get those things aligned. But you're going to get to that. Your signature LER number is going to come very, very, very early in your business, probably somewhere in the $500,000 to $750,000 range. Once you're a larger business, it's reminding them of what the things they did that got them there,
Mm.
because they tend to start to think, oh, we're a bigger business and we should act differently. So, no, no. I mean, you need to hold on to that profitability back there. And I think for the bigger business in a market like we're in, you've also got to understand that if we're not in an expanding marketplace like we have been in, where do you settle out? Or, I mean, you can't just sit still. I mean, you're always going to grow, prune, even if you stay at the same revenue number. But you've got to really have a strategic decision of looking at your market and saying, how do we gain market share? And when do we get to where the next percentage of market share is worth it? And there's a point that you always get to. And then what is your strategy from there? And I'll just plant the seed and we'll talk about this on a later podcast. The emerging trend that I love, and we got multiple clients now that do this, is what I call the emergence of the portfolio entrepreneur.
Mm.
You're going to optimize the primary business you're in and then start another business that may be in a totally different industry. And we're seeing people stack, 5, 10, 15 business units together with one. I mean, business is business at the end of the day. Leadership is leadership. HR is HR. Marketing is marketing. Yes, you use different techniques, but the concepts are essentially transferable across many business platforms. And so this idea of, running, a multiple business optimized entity with a very thin, not a heavy corporate structure, but just the right amount of leadership and skill set that can be more effectively utilized across multiple businesses instead of one. That's an emerging trend that I think you're going to see a lot more of.
Mhm. Yeah, and I have seen that in our
Yeah.
entrepreneur community, not just here in Nashville, but across the country. All right, Greg, last question. In the financial worlds that you live in, but also in the entrepreneurial community that you live in, what does influential mean to you?
Mm. Now, that's a question I've never been asked. Um, I mean, I think influential is someone that is a go-to person.
Mm.
So not so much trying to be influential, but it's someone that is sought out, that, the word that comes to mind is kind of an anchor. Hey, I want to anchor myself in good wisdom, founded principles, and somebody that kind of helps you set the cornerstones of the playing field, in that. And I think, influence is not necessarily always something that's peddled. It's more so of something that's maintained.
Mm, I love that.
Mm.
This has been so good. Y'all, again, I can't iterate this enough and reiterate. It's like the book is a wealth of value. It's like you're going to get an entire financial degree for roughly $25. So get the book, check them out, simplenumberscri.com. Also, feel free to learn about Greg at gregcrabtree.net. Greg, thank you so much for being on the show today. Chock full of wisdom in so many ways. For everyone listening, go check out the recap episode, which will be coming up next. And we will catch everyone next time on the Influential Personal Brand.